All right. Let me know if you can hear me. We are going to proceed because we have limited time for every section. That's why we'll always have this section recorded so that we can finish up at time and then proceed with order of our schedules. So in our last discussion, we introduced a background concept, which is known as candlestick. We introduced a background concept known as candlestick. Let me know if you can hear me and if you can see my screen. You can drop 1 on the chat, or you can signal if you can hear me and you can see my screen. Let me know if you can hear me and you can see my screen. So in our last conversation, we introduced the concept of on a candlestick. If you weren't on that last section, you can go over the recorded section for candlesticks. Exactly what we began. I think this is the first. This is the second section we're having for since we began this the binary masterclass. On that note, we're still on candlestick. That is, what is candlesticks? And just a bit of refresher of what we did on the last time. I introduced candlestick, and I said that candlestick. Okay, we ran through the history of candlestick, right? We did a history of a candle, and then we had all of those sorted out. So we left here with a question of what is candlestick? What is candlestick? And then we know that candlesticks are formed using the open, high, low, close of the chosen time frame. And I explained all of those in a picture form. That's I showed that those explanations. All right, so we're still on candlestick, and we would go from that. So we talked about the high, the close, the open, the low. We talked about the rebody. All right, so we used, of course, we navigated from the live chart. I also dropped the live chart on the platform. It's tradingview.com. You should have tradingview.com on your chart. I'm going to drop it again. I'm going to drop it yet again on. I'm going to drop it again. Tradingview.com. Tradingview.com. What you do once you open the site, you make sure to synchronize your Gmail account on it, and then it becomes, because this I think I made an introduction on TradingView. Or if I've not done that, that means we'll have to go do that. But you can go to our YouTube page. I think we'll have something like that on TradingView. Everything you should know on TradingView. But we're talking about candlestick for now. So maybe we'll progress to giving a broad definition and a broad look on TradingView, then we would do that. So basically, we're looking at candlestick. I think that's the last concept we established after talking about the indicators. Sorry, after giving a background view of what candlesticks are. So I believe we actually did and exhausted that on the last section. So we'll continue from that. All right. So I mentioned something on the other time about long versus short. Long versus short. We're going to start from where we stopped. If you have a problem understanding, then you have to go back to the recorded section. I think I posted a recorded section on the platform, and also is uploaded on the YouTube page. So long versus short, still looking at what is candle, and now the question you should know how to answer. Candlesticks are formed using what? The open, close, right? Just like this definition will have. Please mute yourself so we don't get interrupted. Yes. Oh, mute yourself, please. There's a lot of noise. So I didn't even know I muted myself. I didn't even know I muted myself. I'm sorry about that. I'm going to repeat every single damn thing I've said. I've said a lot of things. I don't even know where I stopped. All right. So we're talking about a candlestick. Previously, we talked about candlestick body, and I mentioned vividly well that a candle is formed using the open, the high, low, and close of a chosen time frame. Now we're talking about what is candlestick, the question of about what is candlestick. And when we ask that question, the right answer to that question of what is candlestick is simply that candlesticks are formed using what? The open. Where did that candle open from? Is a very important question to, or a very important answer to note. The open, the close of that candle, the high of that candle, and the low of the candle. This is, of course, we talk about the real body. This comprise of, these are the components of a candlestick. So if we asked, what is candlesticks? Candlesticks is formed. Remember from the introduction we did the last time, I mentioned about the history of candlestick, and I told you everything about Japanese candlestick and the very major reason why we are learning Japanese candlestick. You can go back on that recorded video. So we're talking about how candlesticks are formed, right? So if you asked, what is candlestick? Candlestick, of course, we know is a visual representation of what is happening in the financial market on a live chart. All right. But then that doesn't answer the question of how to trade in the financial market on candlesticks. Remember, you are not, we're not learning this skill for you to answer questions on words or verbally, but we're learning what we're learning this moment so you understand or have a strong foundation and confidence of how to trade the financial market. And a candlestick means a lot to you because you read candlesticks to understand the emotions happening in the financial market. So it is very important to note these key factors that I mentioned. One, the open of a candlestick. Two, the close of a candlestick. Now, the open of a candle and the close of a candle determines what kind of candlestick that is. Now, we mentioned that if a candle closes above the open, now this is the open and this is the close. So if a candle opened below and closed above, that candle is a bullish candlestick. Let's go to the chart. Now, this candle, this green candle, let me bold into this chart so you see what I'm showing you. This is Euro odd live chart. This candle opened below this, right? And then is above, and it is still running because it's on the hour time frame. Let me change this time frame to just 5 minutes. I have this as 5-minute chart. All right. So look at this chart. This candle opened above and is dropping, and although it does not close yet, but we are very sure that it's going to close still up below. So this kind of candle that opened above and closed below is called a bearish candle. It's called a bearish candle. bearish candle. Now, what it means is a candlestick that is dropping or that is falling, right? But if the open closes above, for in this case where we have open below and close above, we call this candle a bullish candlestick. For in the case of this particular candle here, you can see that it's open below and closed above. It is called a bullish candle. It is called a bullish candlestick. Take note of this. It's called a bullish candlestick. Why? Because we can say that that candle is rising. It's rising, it's going up. Now this candle has closed and a new one has opened. And the open of this candle, this current candle, it opened above and is closing, is going below. So it's going down. They are called bearish candle. All right. So we're still on the question of what is candlestick. And I mentioned very, very correctly that Japanese candlesticks are formed using the open, which is the open, this, the close, the high, and the low. This is what makes up a candlestick. So if you go back to this chart, you find out that on this candle that closed, it recorded a high, recorded a low, and then the real body. But for the fact that this candle opened above and closed below is what makes it a bearish candle. In the other hand, for this other candlestick that opened below and closed above, you can also see that there are little shadows, that is the high and the low. These shadows can also be called wick. All right. These are the component of a candle. So it is very important that you know where a candle opened at and closed, because knowing where a candle opened and where it closes makes you understand what candlestick that formed, if it is a bearish candle or a bullish candle. I hope we're making progress. So we said that if a candle opened, okay, let me go back to this. We said that if a candle, if the close is above the open, that is, the close is above the open, we can say that that candlestick is bullish, which means that the price is rising, right? So if a candle opens below and closes above, we would say that that candle is a bullish candle, which means that what price was rising at that particular time frame, right? Okay, so that's a bullish candlestick. All right. So the most trading platform use, we don't, like I always mentioned, the color does not actually matter. What matters is that you understand what you are doing in the financial market. But preferably for me, I use white to identify my bearish candles and then green to identify my bullish candles. So any candle that opens below and closes above simply tells me that that is a bullish candle. Of course, I know before that happens. Now, easy for you to understand how this works. The previous candle gives you a clue of what the next candle is. Now, the previous candle closed here. And if you're checking the number of that area, we would say that that is areas around 366. Areas around 366. That's this candle. This candle opened, closed at 366. Now, the next candle must begin where the previous ended. Is a key, is a tips to know. The next candle must open or must start from where the previous began. Sorry, where the previous ended. So it doesn't matter if this candle is going to go down or go up. It must begin from where the previous ended. So this candle opened, this bullish green candle opened exactly where the previous bearish candle ended or stopped and did what? Went up. So for the very important reason that this candle opened below and closed above is what makes it a bullish candle. In the other hand, if this candle opened here and ended below, we would have tagged it a bearish candle. It's important I emphasize on this. It is the basis of everything we're doing. If you grasp what we're doing from the basic, truth be told, you won't find it difficult doing everything on the upper hand. You will have a very strong foundation to trade the market with confidence. All right. So in the case of a bearish, if the close is below the open, just as I've already explained, if the close is below the open, we can say that that candlestick is a bearish candlestick. So here, this is an open, and then we have a close. So this candle opened here. Instead of going up, it went down. So for the very fact that it opened above and closed below makes it a bearish candle. But remember that the component of a candle, or what makes up a candle must have an open and a close, and a high and a low. Sometimes some candles those do not record a high or do not record a low. But very important to note that candle must have an open and a close. I hope we are going there. So still on what is candlestick, we're trying to differentiate what candlesticks are and giving a very broad meaning to what candlesticks are, because you will be using a total, should I call it, eye view to analyze the market by interpreting meanings or reading meanings into the visual representations of what you're seeing on the chart. That is the type of trader we want to make you become, right? We don't want to make you a trader who looks at indicators to be able to execute an idea, or who want to look at a particular style of trading. No, it doesn't work that way, because humans are those in charge of this business. So, and humans have emotions, and emotions switches or changes along the way, or from time to time, right? So this is to kind of raise that meaning from your own end. You wake up happily today, you may not wake up happily tomorrow. You may wake up sad tomorrow. That is an emotion switch, an emotion change. So humans bring this emotional ups and downs, even to the business, even to the market. So if you're trading with a signal, or you're trading with an indicator, then be very, very sure that you won't be having a consistent result, because you are not directly involved with the changes that happens in the market, of course. All right. So using the candlestick as a technical base for your analysis gives you an updated happenings and changes in the financial market. That gives you a broad knowledge, a very permanent knowledge of what you're doing in the financial market. So we look at long versus short. All right. So long bodies refer to strong buying or selling pressure. Long bodies. All right. So in your journey of analysis, you would meet several times long body candles and short bodied candles. You meet short candles, you meet long candles. It's very important you know what these both candles mean. Mind you, everything that happens in the financial market is highly calculated. Nothing happens for no reason. Everything that happens in the market happens for a very, very strong reason, and they are highly calculated. So you know the psychology behind each candle's formation from the order. So long-bodied candle simply means what? Strong buying or selling pressure. So if you see a long candle that goes, or that is up, that is that closed above the open, that it opened here and closed here. In this case, that is a strong buying pressure. All right. Let's see what that. Let's go to the chart. So this candle has a long body, All right. So having a long body simply shows that there is a strong buying pressure. This has a long body. The bearish, the white candle, it has a long body. Hope you can see my chart. A long body, which represents what? That is high selling pressure. High selling pressure. So that is what we're explaining on this term, long versus short. And you of course have in the market where we have short candles or short candles, which means what? Low or small buying pressure. You can see them in here. There are short candles all around. The bearish candle, short bearish candle, short bullish candles. They are always there in the market. This is a very long one. This is short. This is long. This is short. So the long candles means strong pressure. It can be bullish. It can be bearish. But know what they mean and know what they don't connote. It's very important you take note of those while we continue. So after that, we look at conversely, if there is a bearish candlestick in which the open is above the close with a long body, this means that selling pressure controls the market during the chosen time frame, right? Short and small bodies indicate little buying or selling activity, like I've explained. Long, that short candles simply what tells you, excuse me, that there is little selling pressure involved at the particular fix or at the particular time. All right. So we have done justice to long body candle and short body candles. We've done justice to open, close of candlesticks. We've done justice to that. So you know that a candle that opened below and closes above is simply a bullish candle, which means price is rising at that particular time. For bearish, a candle that opens and closes below, that is, it opened above and closes below, simply tells you that that is a bearish candle, which means that what? Price is falling at that time. Now, let's talk about the wick. Now, candlestick shadows, or you can call it tail, or you can call it wicks. I hope you are jotting down. I prefer calling this wicks, all right? I prefer calling it wicks. You can see my screen. Of course, I know you can see that. If you can see that, I'm sure you are. You can. All right, so the wicks, let's talk about the wicks. Japanese candlesticks with short wicks indicates that most of the trading actions was confined near the open and close. I want to explain something before I go deeply into wicks. Now, let me use a practical instance to explain this. Now, when you want to reach out for something above you that is not under your reach, you tend to jump. You jump up to grasp it. This is what the market did here, that recorded this week. So the market does not have capacity to get to this zone. Let's say this level, 50 zone. This is a Fibonacci zone, actually. So let's say the market does not have the strength or the height to get to this level, but then it stretches. It stretches. But you know, whatever that stretches would definitely come down to its level. The law of gravity, what goes up must come down. It's just simple what happens there. So let's say you jump up. When you jump up, you definitely come down to your normal level. So this is what happens here. This kind of stretches, stretched up. And when it's stretched, of course, that's not its base strength. It had to come down and then leave it a print. So you find out that sometimes when you jump to probably hit or touch a ceiling or touch something, your fingers can actually create a map or a print on those levels, on the place your feet or your hand touched. So this is what happened here, and that is how a wick is created. This is how a wick or shadow or tail is created. I'm making emphasis on this because I don't want you to forget about them. So this is how a wick is created, and this is a long upper shadow. You can also call it a wick, all right? You can call it a tail, and this is a long lower shadow. If a candlestick has a long upper shadow and short lower shadow, this means that buyers flexed their muscles and bid price higher. I repeat, if a candlestick has a longer upper shadow, this is what we're talking about, a longer upper shadow. This means that buyers flexed their muscles and bid price higher. Is that understood? Now, what we're trying to say is here, buyers do not have the capacity, the strength to pull price to this juncture, to this zone. Look at the zone. Let me elaborate the zone. To this zone. But they struggled. If you had seen this week in operation, you would know that at the point, the full body got here before it started dropping. All right. So that means the buyers in the market flexed their muscles to get to this point. But as it will always be, their strength, that is not their average height. So they have to come down to an average height. I just want you to know the psychology behind each of the things you see on the chart, because we'll end up becoming a professional analyst using chart pattern. We call you price action traders. Price action traders. All right. So, but for one reason or another, sellers came in and drove price back down to end the section near its open price. So I'm telling you, we're trying to make you understand the wick, what it means, or how it came about, what the wick, what it means, and how it came about. All right. So if a Japanese candlestick has a long lower shadow here, a long lower wick, or a long lower shadow, it means that sellers flashed their washboard apps and forced price lower. But for one reason or another, buyers came in and drove price up. Now, let me use a grammatical expression to explain what the wicks are. More importantly, the longer wick. Let's say buyers, let me use for instance, buying activities and selling activities is not quite different from what you do in the market or in your regular market. It is not quite different. It's just that this is a more digitalized way and a more lucrative way, right? So it's similar, but let's take for instance, let me use this scenario to explain a week what happened there. Now, let's say, for instance, you bought an item, set the price at $200. You decided that I'm going to sell this. You bought this item for $200. So as a buyer, as a seller, you went with this item to the market. You fixed the price for this item at $250. So when you sell this item for $250, you will make a gain of what? $50. The capital for this item was $200. You went to market to sell this item for $250. But then, as a businessman, you know that in any circumstances in the market, or whether, let's say, a more, you visualize a customer that he doesn't have a clue of what this is sold in the market, and then you decided to skyrocket the price to $300, and you tell the customer, I'm going to sell this item for you for $300. Maybe this customer decided to bargain price with you. Finally, you sold the item for $280. What happened there is this: you flexed or you dragged price above to 300, but the seller or the buyer, whoever it is, dragged the price down a bit, but left you with what? More profit than you bargained. This is what happens on the week. So here, buyers priced or flexed their mugs so higher to what? To gain more profit or to accumulate more fund. But then sellers came in and drove price down to a good close. And then that is the psychology behind this. I'm using this instance to kind of create a picture in your mind to know what happened on that long week, all right? Or to create a psychology behind the formation of a wick or a pay or a shadow on a candlestick. It's very important, all right? So, excuse me. All right, so on the other hand, I think I've explained. So I repeat again, if a Japanese candlestick has a long lower shadow and short upper shadow, this means that sellers flashed their dashboard apps and forced price lower. But for one reason or another, buyers came in and drove price back up to end the section back near its open price. So I believe I have created a very understandable picture of what happened there. So to refreshing your mind over what we've done so far, we talked about candlestick. I will go over a brief history of candlestick before we wrap up the section. I think we'll have another section coming up at 1 or so. I'm not sure though for now. So I mentioned previously that candlesticks have been around lots longer than anything similar in the Western world. These are called Japanese candlestick. All of this you see here, they are called Japanese candlestick. And we know them to be tagged as the language of the market. For instance, you travel to a foreign country, and in that country, you don't know how to speak in their language. You would end up not flowing, not communicating well. This is what happens in the market. You're trading Forex and you cannot understand what the candlesticks or what the language that the market is using to transact business, then you will definitely end up becoming a novice and a newbie and keep on losing out on opportunities. So we said that Japanese candles, that the Japanese were looking at charts as far back as 17th century. All right? We talked about a lot of things on that regard. We talked about the Homer, Homer as the founder of Japanese candle, right? So we are not trading with bar chart. The reason why we're trading with Japanese is because it is the most profitable way to analyze the market. One, benefits. Two, the idea of learning or mastering how to analyze market on candlestick gives you wide knowledge, broad knowledge of literally everything that has to do with market, be it stock market, crypto markets, oil markets, bonds, Twitter, gold, silver. All these markets can be analyzed using the chart, candlesticks. Or we can say that all these markets are based on candlestick analysis. So if you know how to analyze on candlesticks, you, of course, has equivalent knowledge to sky any market, any financial market in the world, of course, including the forex market, which is the largest financial market on earth. So this gives you a broad knowledge. So we take a short break. If we're going to come back, we look at the next concept we'll have in line. All right. So let me make sure that we save this particular audio and then prepare for the next section.